Welcome back and thanks for joining. We are going to start on chapter 11 today. All right, we're going to read chapter 11, which is titled Trading. Just the word. So we'll see what this is about. All right, chapter 11, Trading. I'm going to jump right into it. The real fun begins after a day trader has developed a strategy, established a trading plan, and paper traded for a period of time in order to gain detailed understanding of the market. While these activities have certainly helped traders prepare, there's nothing like the experience of trading in a live market. When real dollars are at risk, traders should trade conservatively during the first few months to get a feel of the difference between paper trading and live trading. In this section, we'll take a look at what happens when traders actually put money into the market and review some of the typical daily routines. Before. A day trader begins the day well before the market opens, with pre-market news, price action, and other factors that could influence price throughout the day. With a world of information available at one's fingertips, it's important to become proficient at separating what's relevant from what's not. Day traders can eliminate many of these inefficiencies by finding and using the right tools to screen for opportunities and follow up on only what's important. Some opportunities to watch out for include: number 1, top movers. Top mover lists highlight stocks that are making strong pre-market higher or lower moves for a variety of reasons. These lists are typically the first stop for day traders looking for opportunities, since they tend to be a stronger predictor of future price movement when the market opens. Number 2, economic releases. Macroeconomic releases have a significant impact on the financial market, especially for traders focused on trading indices or currencies. In general, the biggest releases are those covering employment and consumer spending, while some releases impact certain areas of the market more than others. Number 3, earnings releases. Corporate earnings drive stock prices, and earnings releases can cause significant volatility in the information as the information is digested. Oftentimes, stocks will gap higher or lower after a pre-market or aftermarket earnings release, and then spend the opening hours trying to find an equilibrium price. Number 3, analyzing ratings. Analysts' upgrade and downgrades can have a significant impact on stock prices, depending on the analysis, companies' ratings, and other factors. While analysts aren't exactly known for their long-term accuracy, changes in their ratings are still notable events for traders looking for potential short-term catalysts. Number 4, M&A announcements. Mergers and acquisitions are responsible for the majority of volatility in the market. Although arbitrageurs quickly lose the gaps between purchase and market prices, day traders often focus on overreactions to such announcements or on thinly traded securities that may not immediately move. In addition to watching for these opportunities, day traders will usually screen for technical opportunities that may arise even with no news at all. Hitting the wires. Breakouts and breakdowns can occur for a variety of reasons, including things as simple as perceptions or rumors, which may create short-term opportunities to profit. For instance, rumors of merger in certain industry can cause speculation across a number of securities, causing them to break out from their prior resistance and establish new support levels. The number of positions to have open at any given time depends on many factors, including the amount of capital available, risk tolerance, and the number of opportunities available to choose from on a given day. Money management techniques often provide a good baseline for the maximum amount of capital to risk on any individual trade, but the true amount depends on the day trader's risk tolerance and confidence about a given trade. The key is ensuring that no individual trade risks a substantial amount of capital in a way that could bring the entire portfolio to its knees if the prediction turns out to be wrong. The next step after identifying opportunities in the market is establishing the plan for when the market opens. Oftentimes, traders will lay out take profit and stop loss points for the positions based on technical factors, and will enter those limit orders when the trade is placed in the morning rather than worrying about them after the fact. During. The most important part of the day trader's day is between 9:30 a.m. and 4 p.m. Eastern Time, when the U.S. stock market is open. The greatest volatility is often seen between 9:30 a.m. and 11 a.m., with second wind coming during the latter part of the day, between 2 p.m. and 4 p.m. Discretionary day traders are often most active in these early and late hours, while systematic day traders don't really focus on any particular time due to their reliance on a set of rules that could be executed at any time. Buying. The first opportunity the day traders have to buy is during pre-market, between the hours of 8 a.m. and 9:30 a.m. Eastern Time. During these hours, traders can get a leg up on the competition by acting before the crowd in response to earning releases and other market-moving events. The trade-off is the market is much less liquid and price discovery isn't quite as certain. For instance, traders may bid up the price of a stock during pre-market hours after an earnings release, but the shares may end the day on a lower note once the numbers are digested. The prices of pre-market trades are often significantly higher or lower than initial market prices. For this reason, traders must establish a new baseline for their assumptions after the open. The first step in the trading process for most day traders occurs after the market opens. With many different order directions, types, and conditions, day traders should familiarize themselves with the ins and outs of each type of order so that they can make the most suitable choices for themselves. Most traders use limit orders to place longs and short trades, and stop orders to limit risk. Stop limits can be used to set take profit points, and trailing stop loss orders can be used to lock in profits over time as well, creating additional opportunities to fine-tune a trade. The two possible directions for a trade are long or short. Long. A day trader that buys a stock is said to be long in the stock, which was originally intended to mean that they were holding it for a long term or for the long term. Of course, a trader that buys a stock is betting on the stock appreciating in price over time. A day trader that bets on a price going down may decide to go short on a stock, which involves borrowing shares and selling them with the promise of repurchasing them in the future. Since they receive cash for shares up front, the idea is that they will be able to repurchase them for a lower price in the future and pocket the difference. After deciding whether to go long or short on a stock, the next step is to decide what kind of order to place, which dictates how the trade is executed. The majority of day traders use limit orders to place trades since the price is then guaranteed. Although only market orders will guarantee that a trader enters a position regardless of price. The risk with market orders is that the price paid may be significantly higher than the planned amount, particularly during volatile times when the prices move very quickly in one direction or another. Major order types include market order. Market orders instruct a broker to purchase an asset at the next available price in the order book. These orders are designed to execute a trade as quickly as possible without much regard for the execution price. Limit order. Limit orders instruct a broker to purchase an asset at a certain price or lower in the order book. Unfortunately, these orders cannot be guaranteed and could lead to some missed opportunities for traders. Stop loss. Stop loss orders instruct a broker to sell after a stock has reached a certain price in order to prevent further loss. Stop loss orders instruct a broker to sell after a stock has reached a certain price in order to prevent losses. Like market orders, these orders are designed to exit the position as quickly as possible. Okay, stop limit. Stop limit orders instruct a broker to sell a stock at a specified price and only at the price, which means that these orders may have many of the same limitations as limit orders in terms of guaranteed executions. Trailing stop loss. Trailing stop loss orders instruct brokers to place a stop order at a defined percentage away from a security's market price, which helps traders protect gains while keeping the position open and exposed to further upside. After selecting an order type, the next step is to establish how long the order should remain in effect until it's canceled. Most day traders avoid holding any position overnight, which means that many of these durations aren't entirely relevant, but provisions like fill or kill and immediate or cancel shouldn't be overlooked. These provisions can be extremely useful for avoiding partial fills and for precisely targeting near-term opportunities, respectively. In some cases, day traders may use long durations that last for multiple days. Major order durations include day order. Day orders instruct a broker to keep an order active until the end of the day and then cancel the order if it isn't filled. Since day traders rarely hold positions overnight, these types of orders are interchangeable with many others. Good till canceled, or GTC. GTC instructs the broker to keep an order active until it's canceled by the trader, even if that means keeping the trade open for several days, weeks, months, or years. Fill or kill. Fill or kill orders instruct brokers to either execute an entire order or not execute at all. These order types are useful for avoiding partial fills, which can quickly run up transaction costs and lead to uneven returns for day traders. Immediate or cancel. Immediate or cancel orders instruct a broker to execute the trade immediately or cancel it entirely. If a day trader is targeting a very near-term opportunity, these orders can be valuable to try to secure a quick execution. On the open. On the open orders instruct brokers to execute trades as close to the opening price as possible. While they're not always a good idea to do during open, due to opening volatility, these orders can be used for buying as soon as possible. On the close orders instruct brokers to execute trades as close to the closing price as possible. If the order cannot be executed, the order is canceled entirely and the day trader must hold the stock overnight. After establishing the order type and duration, day traders must decide if they are going to add any conditions to the order. The most important conditions relate to whether or not an entire order is filled, and how X dividends and the like affect limit prices. In general, most traders prefer to use all or none orders to ensure that trades are executed at the right price, without worrying about partial fills and other similar concerns. Common conditions for orders include all or none. All or none conditions instruct brokers to either fill the entire order or not fill the order at all. For example, an all or none limit buy order for 1,000 shares at $15 will only be filled if all 1,000 shares can be executed at $15 apiece. Do not reduce. Do not reduce conditions are restrictions placed on good till canceled orders that instruct brokers to prevent limit prices from being changed due to a dividend when a stock goes ex-dividend. To summarize, most day traders place fill or kill limit orders designed to ensure that they get a good price and a complete fill. While market orders guarantee execution at a price, limit orders ensure that the orders are filled at the desired price. Or the only exception to the rule is when traders are willing to assume the risk associated with slippage in order to guarantee that they receive at least some shares within a specified period of time. For instance, traders may have an exceptionally high price target after a particular piece of news, whereby they may be able to justify using a market order and paying a higher price to get in on the action. Day traders set prices for these limit orders based on either technical or timing factors. For example, a trader may place a stop limit order for a stock that is trading just below a key resistance level within an ascending triangle breakout pattern. The stop limit order's stop price would be placed just above the key resistance level in order to ensure that the breakout occurs before the trade is executed, and a fill or kill order may be used if the price is important. Timing factors may also come into play, such as instances where a trader would like to buy a stock before an earnings release, based on a bet that earnings will beat expectations. In Figure 29, the SPY closed the previous session nearing its prior highs on strong volume, which suggests that a breakout could occur during the next session. A day trader might consider playing a stop limit order to buy the index at 201.70, which is just above the key breakout level, in order to try and catch a piece of the movement near the open. After the trade is established, the trader may place a stop limit order to sell just below the 201.50 level, which represents a key resistance turn support level moving forward. Systematic traders using trading systems that place trades automatically are free to focus on refining their strategy. In general, these traders will still keep a close eye on the trades being executed in order to ensure that the system is performing correctly, especially when the trading system is new or recently refined. These traders may also have to put in certain stocks into a basket to be analyzed. These traders may also have to put have to input certain stocks into a basket to be analyzed. In the event the trading system doesn't automatically screen for opportunities. It's also important for day traders to remain aware of their margin requirements at all times. Pattern day traders in particular must maintain $25,000 in equity at any given time in order to avoid account restrictions and potential margin calls. Brokers may have their own requirements geared towards day traders for all types, including minimum margin requirements that should be understood in detail to avoid costly margin calls or other issues. All right, cool. We're going to kill it right there for now, And then next time we'll go over managing positions. Yeah, we'll go over managing positions, and yeah, we'll do managing positions and then some other risk factors. All right, cool. Thank you for joining, and see you next time.